Markets have been again continuing the nice run. We were at all-time highs last week, actually, and then last week we had a little bit of a pullback. This is at the close of business on Friday, 6,500 for the S&P. Again, Friday was a little bit of a down day. You can see here where we are with the current PE ratio, still elevated, 22.2 times earnings is what the S&P 500 is trading at. So elevated, a big number above the 30-year average. You can see that, the 30-year average is at 17.1. A lot of that is kind of being pulled up a little bit by some of this recent higher than normal, PE number that we've seen, or more elevated number that we've seen recently. Um, this 30-year average, if we were going back to call it 2018, 2017, was probably closer to 15 and a half or 16. Now we're inching up. I think last month the 30-year average was 17 even, and now it's 17.1. So these higher numbers are kind of making that average drift north a little bit. But again, 22.2 is the PE ratio. Again, no set formula for this. Back in the late 90s, we were above 24 for a period of time, and then there was a pullback. We're starting to hear some people kind of talk about, correction and a market pullback. I had a couple clients reach out about a recent book that was written on 1929, the Great Recession pullback, and market similarities to that. So time will tell. I don't think you can make an exact comparison. Even though valuations are close to where they were in the late 90s, the environment's not the same. Corporate profitability, the companies that made up a big part of this elevated PE ratio, they weren't as profitable as they are today. So the corporations today have a lot more earnings and a lot more profitability. So hard to make that exact comparison, apples to apples comparison.